Amazon, a name that needs no introduction. From dominating e-commerce to leading the cloud with AWS, this tech titan has shaped the way we live and work. But here's the big question. Is Amazon still worth its price, or are we looking at an overvalued stock? Amazon just reported earnings. I'm revealing my own analysis on the intrinsic value today. Please watch on to see how my valuation helps you determine if it's overvalued. First, let's break down the business. Amazon is more than just an online store. Sure, we know them for delivering almost anything to our doorstep, but their biggest cash cow is Amazon Web Services, AWS. This cloud service dominates with over 30% of the market share. Then there's advertising and their rapidly growing subscription service with Prime. The company is a true behemoth, touching multiple industries. Amazon Go and Amazon Fresh are revolutionizing the grocery shopping experience. Amazon Studios produces award-winning content, adding another revenue stream. Their devices, like Echo and Kindle, keep customers within the Amazon ecosystem. And let's not forget their extensive logistics network, which is a backbone for their operations. All these ventures contribute to Amazon's impressive financial growth and stock performance. In the latest earnings report, released just a day ago, Amazon posted revenues of $170 billion, with a 10% year-over-year increase. Most notably, the company's free cash flow has skyrocketed to $38.2 billion, a huge improvement from negative figures last year. Sounds promising, right? However, there are signs of slowing in Amazon's core e-commerce business. Growth in online sales has decelerated, reflecting market saturation and increased competition. While Amazon Web Services continues to perform well, the slowdown in e-commerce could impact overall growth. Investors should keep an eye on these trends as they could signal future challenges for the company. Despite these strong numbers, Amazon's stock has taken a hit. At $238 per share, it seems the market isn't entirely convinced. But why? Well, the market may be overestimating the future growth of the company, and that's where our DCF analysis comes in. Let's dive into the numbers using the DCF method. With the help of my Google Sheet, you can easily estimate the intrinsic value for AMZN, which is about $161 per share. You can download it from link in description below. Now I've assumed a 10% growth rate for Amazon over the next 5 years, which is more in line with historical growth rates and analyst expectations. While Amazon has been a growth juggernaut, a 10% growth rate is conservative, given that the company's revenue growth has been slowing from the 20 to 30% range in previous years. This 10% growth rate assumption reflects a more balanced view, aligning with the growth rates analysts are forecasting. In the past, Amazon has averaged annual growth rates around 15 to 20%, but given the saturation in key markets and more competitive pressures, 10% seems more reasonable. Analysts generally expect Amazon to maintain strong, though decelerating growth, especially with heavy investments in AI and logistics. This makes sense considering their strong track record, but also the challenges in maintaining such high growth at Amazon's scale. Quick reminder, if you're enjoying this analysis, don't forget to hit that like button and subscribe for more in-depth stock breakdowns. Your support means a lot. However, let's not forget that there's always a bullish scenario here. Amazon isn't just a retailer, it's a market leader with a massive moat. Its dominance in e-commerce and cloud computing is unparalleled, and AWS continues to lead the industry. Furthermore, Amazon is heavily investing in AI, which could unlock new growth opportunities. From AI-powered logistics to expanding its reach in AI-driven services, there are plenty of reasons why investors may still be willing to pay a premium for the stock, believing in its long-term growth potential. But as always, we need to stay realistic about expectations. Now here's the caution. Just because Amazon is a powerful company doesn't mean its stock is immune to being overvalued. Jumping on a stock just because it's popular is a dangerous game. We've seen this happen time and time again. Investors buy into the hype without checking the fundamentals. If you want to avoid overpaying for stocks and make informed decisions, I've created a free DCF Google Sheet you can use to evaluate any stock before jumping in. The link is in the description below. Stay wise, stay patient, and remember, not all hype is a good investment. That's it for today. Amazon remains a powerhouse, but don't let its success cloud your judgment. Always evaluate before you invest.